Dr. Dean Smith is a partner with Kadesky & Associates LLP and the president of Kadesky US Tax Ltd. Kadesky is a boutique accounting firm which provides only taxation services. Dean has been involved with expatriate tax work for over 23 years, assisting companies moving employees around the world. Clients also include private individuals who have multiple jurisdictional filings. Dean is also a faculty member and writer with Knowledge Bureau. Some of his career highlights include graduate certificate in estate planning, Golden Gate University, San Francisco, a PhD in financial accounting from the University of Waterloo, and an honors BCom from McMaster University in Hamilton, Ontario, Canada. Some of his noteworthy engagements include being a chair, British Canadian Chamber of Trade and Commerce, past chair tax committee for the American Chamber of Commerce in Canada, member of the Society and Trust and Estate Practitioners in Toronto, Chartered Professional Accounting, CPA Ontario and CPA Manitoba, a certified public accountant in Illinois, a certified financial planner from the Financial Planners Standards Council. His areas of practice include practice leader, U.S. tax services, for high net worth individuals with cross-border needs, planning and compliance, Canadians, individuals, Canadian corporations looking to invest in the United States, structuring, planning and compliance, American individuals and U.S. entities looking to invest in Canada, and cross-border personal tax for the Canada, U.S. and U.K., cross-border estate tax planning and compliance, U.S. estates and trusts. Welcome.
Good morning, Virtual Acuity DAC 2020. I hope that you enjoyed day one of the conference and that you're having a great day so far, wherever you are joining us from. My session is scheduled for 40 minutes, but I have some 51 slides in my PowerPoint presentation, so due to time constraints, it will be impossible for me to talk about each slide in detail. I debated as to whether to remove some slides, but decided to leave them in so that you have the background information. Evelyn covered some of the economic issues in her opening presentation yesterday, so let's get started. So what are we going to cover today? Here's the agenda. We're going to look at who are the future high net worth clients, where are those future high net worth clients going to be located, what assets comprise their wealth and where will those assets be located, what political changes may impact future wealth. Are we going to have some increases in tax rates? Is there going to be a broadening of the tax base? An introduction of wealth taxes? We're going to then look at the CRA and the issue of real estate. Some ideas to consider in respect to that real estate, or should we even consider those? And we'll look at some U.S. issues because we have the U.S. election coming up on November 3rd, and there could be significant changes because of the outcomes of that election. And what is your role in all of this? You need to make sure you have a discussion with your clients and understand what their goals are, what their assets are, and how you can assist in creating wealth for them.
The question obviously becomes, who are the future high net worth clients? I think first we have to look at what the generations that we currently have are. We have the elders and the baby boomers, and these were the individuals born, around 1946 to 1964, and they represent the post-World War II baby boom. We then have the Generation X, which ages approximately from 1965 to 1980. Followed by the millennials, also known as the Generation Y. This is from the 1981s through 1996s, perhaps to the early 2000s. And then we have the Generation Z or Generation Z, depending if you're American or Canadian. And this counts, people born between 1997 and 2012. The next obvious question, of course, is what is the next generation?
So then let's look at inheritance, where your clients are getting their money from. Of course, many of them are self-made, but many of them too are going to be inheriting the wealth from their prior generations. So we'll look at the elders to boomers, and really it should be elders and boomers and also to the Generation X. So over the next 20 years, Canadian baby boomers are expected to inherit Canadian $1 trillion. Is this still true in the post-pandemic era? I think it is. We saw some valuations discounts in March and April in the stock market, but by and large, those have recovered, and the stock market actually seems to be pretty robust at the moment. We also have boomers to millennials, and globally it's expected that some US $16 trillion will be transferred over the next 30 years. So who will be the ultimate beneficiaries of this wealth transfer? Of course, the CRA may share in some of it due to the deemed disposition on death rules. But I think people under the age of 40 today are going to be the big winners, as they're going to inherit from both the elders, the baby boomers, and the Generation X individuals. And also they're heavily into the dot-com boom. And if we look at the current increases in the market, a lot of that has to do with the dot-com technology. Amazon, Google, etc., Spotify, all those type of electronic-based companies which are increasing the most wealth. So where will the future high net worth individuals be located? There's some global uncertainties. We have trade tensions, especially between the US and China, and we've had issues between Canada and China. We've got the upcoming US presidential election, Brexit. They still haven't negotiated a final deal between the UK and Europe. The oil sector continues to have some problems. We've also seen that the Liberal government has been quite unfavorable to Canadian private businesses and introduced the TOSI and some other tax impacts which have negative influences. As a firm, we've seen some high net worth individuals quietly leave Canada and move to the United States because they're just fed up with the tax situation here. So not only is the issue whether your clients will invest in Canada, but whether your clients will even live in Canada. So let's continue on. In Canada, though, we're expected to have economic growth about 1.7% this year. The housing market is still relatively strong, and household consumption, surprisingly, is up. We have low interest rates, and this again helps the housing market. It makes the cost of buying relatively cheap. We have a weak dollar relative to the US dollar, and this benefits our exporters, increases their sales. We expect Quebec and BC to lead overall economic growth this year, but the biggest improvement we expect to be in the prairies because of the slowdowns that they've had there, and also in the Maritimes where they've got population growth. And I personally know of two families that have moved to New Brunswick and Nova Scotia based on the fact that the housing there was so much cheaper. For one example, this family sold their modest home in Hamilton for $600,000, and they bought a mansion in St. Stephen's, New Brunswick for about $230,000 and managed to bank the rest. So that's a significant issue as well as the boomers retire and that, where are they going to go? So what assets will the high net worth individuals hold? And not only the high net worth individuals, but I think you'll see most families, the biggest asset that they own is real estate, whether that's their principal residence, a cottage, investment property. Real estate is a significant part of anyone's overall net worth, and I don't see that changing. We especially see that so in baby boomers. We look at the ballooning prices in Toronto and Vancouver. So how does this impact their overall financial advice that you give? Do they have access to the capital in their houses? Some companies that push the reverse mortgages. Is that an option? How does this impact their tax planning? Because by and large, under current law, the principal residence is still 100% tax-free, subject to the half hectare limitation in size, but there's no dollar amount that's restricted. So will that impact their future tax planning? Where are they going to get the money from? Things you need to sit down with them and discuss. What are some of the issues with respect to Canadian real estate? First, if you want to claim the principal residence exemption, you now have to report it in Schedule 3 and Form T29-1. Historically, that wasn't required, but it is now mandatory filing. Are you going to rent the property out? Are there change in use rules going between a personal use property and a rental property? Are there HST, GST considerations? Yes, there are for new builds and significant renovations. Flipping is a CRA target. BC introduced a speculation tax to cut down on empty buildings in the Vancouver area. Potential upcoming tax changes. What about immigration? Immigration impacts the demand for housing, which in turn demand and supply impact the pricing. So we're going to look at some of these issues. In addition, we have an overall CRA crackdown on non-compliance, and in particular the real estate sector. So since 2015, the CRA has raised over $1 billion in tax revenue, and that's from 34,000 audits in Ontario. And they've also done audits of GST, HST rebates on the purchase of new build homes in the Vancouver area, and this is a result of some 7,400 audits in British Columbia. The 2019 budget created a real estate task force which will focus on Toronto and the Vancouver markets. So what is it that the CRA is going to focus on? Compliance risk being source of funds. So if you sell a property, the question then becomes, where did you get the funds to buy the property? And if it's an expensive property and your history of income doesn't seem to support that, the question then becomes, where did you get the funds to buy that property? And that could lead to a case of unreported income. Number two, we've seen that property flipping is becoming a significant issue. We'll talk about that a bit later. Three, the unreported GST, HST on new construction and significant improvements, whether that's been reported or not. And CRA is actually going after property developers and builders and asking them to release information about purchases and pre-construction assignment sales. We'll look at unreported capital gains, and this is the Schedule 3 issue. And also finally, the issue of unreported worldwide income. The CRA's actually commenced a project whereby they're looking at U.S. data to determine if any U.S. real estate transactions are related to Canadian resident taxpayers. We know that in Canada with a principal residence, there's no dollar limit as to the amount of gain that may be excluded. There is, however, a size limit, and that's a ½ hectare of land that can be claimed as principal residence. If you have more than that, the question then becomes, could you have subdivided the land, or do you need that additional land for your enjoyment? Having more than a ½ hectare, it's not always a guarantee that you may be able to claim the additional land as part of the capital gains principal residence exemption. If you have multiple properties, you must designate one property per year per family as the principal residence. So that becomes a decision at the time when one of the properties is sold. You have to declare it in Form T-2091, which is a designation of properties of principal residence. You also have the issue of reporting it on Schedule 3. And again, if you've got multiple properties and you're flipping these properties, the question becomes, is it a capital gain versus an inventory? And if it's a sale of an inventory, that would be on account of business income and fully taxed. And again, as I mentioned earlier, the source of funds. Where did you get the money to buy the property in the first place? The whole issue of home flipping has become quite significant in the last few years, especially with the increases in the prices in Toronto and Vancouver, where people are buying condos pre-construction and selling them for significant gain before they take possession. So what is property flipping? It's when individuals, including real estate agents, buy and resell homes in a short period of time for a profit. I think you, as the advisor, need to sit down with your client and find out how many properties have they owned in the recent years and what was their intent of the property when they purchased it. Did they purchase it with the intent of living in it long term, or did they purchase it with the intent of, well, I'm going to do some renovations and flip it pretty quickly? I have had some clients that have done that on a fairly consistent basis. Every 2 or 3 years they buy a property, fix it up, and sell it. I have, if in my opinion, if CRA were to question that, they'd probably lose, because clearly their intent there was to buy the property and make a profit on it. So another thing that you have to remember is claiming the principal residence exemption is actually a two-step process. It's not automatically tax-free. And the first one is you must have a capital gain when you sell the property. And if you have a capital gain, then you must designate the property as your principal residence in order to exclude all or portion of the gain. So let's go back to the first one. Is it a capital gain? And again, if you're flipping the property, that could be classified as an adventure in the nature of trade, and it's going to be taxed as ordinary business income, which means it's not a capital gain, and that means that you cannot take the principal residence exemption against it because you don't have a gain to start with. Again, we also have to look at if it's a new construction, whether there's GST, HST issues that may apply. I had one family who built a fairly substantial home, and before they could move into it, the wife was transferred. She was with one of the major banks. The wife was transferred to a subsidiary bank in one of the Caribbean islands, and so they never moved into the property. And the CRA came along and assessed them on GST, or pardon me, HST, because it's in Ontario, on a new build. We managed to challenge that on the basis that it was always intended to be their principal residence, and then it was her work situation that caused them not to actually move into the home. What about if you've bought property with the idea of subdividing it? Well, first of all, can you legally subdivide the property to be sold? I had a client a number of years ago who, as Toronto is expanding, lived in the Markham area as a farmer, had 25 acres of land, and lived on the land, obviously, and farmed it. And a housing developer came along and bought the whole property for about $25 million. And the question was, could he claim the capital gains exemption on that entire $25 million? And it turned out in this case he could. Why? Because he couldn't subdivide the land. It was all his. There was no way he could sell a portion of it and maintain his principal residence. He had to sell all of it, which included his principal residence. And because of that fact, we were able to argue successfully against the CRA that the whole gain should have been excluded. So again, first of all, can you subdivide excess property in excess of that half hectare? What was the intent when you purchased the property? If you always bought it with the intent of developing it, the land, and subdividing it, that's not a principal residence, and that's not a capital gain. That's going to be inventory. Now, if you're going to do that, have you thought about putting that property into a CCPC instead, whereby you have access to the small business rates on the active business income, the activity being the development and selling of the property. If you own the property before you transferred it in, of course, you have a valuation issue to consider. But once it's a CCPC and you're treating the business income, then your expenses, should they be expensed or can they be capitalized? But if you have a loss on that property, those losses are now 100% deductible. And if you have a gain, again, because you're going to be taxed at the small business rate, you have a significant lower gain and upfront tax hit, and you have the deferral. Remember, in Ontario, for example, the small business rate is 13.2% versus a 53.53% top rate for an individual. If you're a farmer, should you be using the capital gains exemption? Well, first of all, the property has to be a qualified farmer fishing property. You have to look at what is the farmer giving up. How was title originally taken? Should you have been in anticipation of a sale? Can you transfer title so each person is able to claim a capital gains exemption? Remember, the capital gains exemption is based on an individual, not on the property itself. So if you have multiple legitimate owners, you could have multiple capital gains exemption. Can you claim a capital gains reserve? Is that an option? All things you should be discussing with your client. This slide just covers a couple of examples, but given that I've already talked about this and in the aspect of time, we'll just move on. Some unusual circumstances that you and your clients may come across. Expropriation. That's when the government comes in and basically forces you to sell the property to them. The amount paid constitutes proceeds of disposition. So this goes back to the issue of what was the intent of your land when you bought it? Was this your principal residence, so you could claim the capital gains exemption on the principal residence, or was this inventory such that the net proceeds is going to be a sale and you could have business income? But with an expropriation, you have the option of what they call replacement property rules, and most expropriations are unexpected, so you have 24 months to replace the property. The issue then, the property, though, has to be a former business property. It couldn't have been your principal residence. Another issue to look at is what happens if the land has gone up in value, but the building is basically not worth much. So normally when you sell a building for proceeds less than its tax cost, being the UCC, you have a terminal loss. Again, each building is in a separate Class 1 pool for CCA purposes, so you'd have a terminal loss on the disposition. In this instance, though, that terminal loss is denied and it's reduced the capital gain on the land. The reason being, you can't have 100% loss but a 50% gain on the land. The government just felt that was unfair and as such brought in legislation to curb that type of activity. Another issue that comes up and has to be considered as part of your planning is what happens upon the death of the real estate holder. Is there a bequest to an adult with or without the principal resident exemption? So as we know, we have a deemed disposition on death. For the adult recipient, we have a stepped up adjusted cost base for the fair market value. The income, if you don't claim the principal resident exemption, or pardon me, the capital gain, if you don't claim the principal resident exemption, will be taxable on the deceased terminal one. And why would you want to do this? So there may be some reasons that you want to address, but again, you have to consider that as part of their estate plan, that it could be a transition on their real estate that they hold. And also we have to look at for the farm property. There are special rules for farm property where the transfer of the farm properties to a child, and the child is defined to include much more than a minor individual, and the notes have it in there. What this transfer does is it refers the gain, recapture, or terminal loss to the date when the beneficiary disposes of the property. So it doesn't eliminate the gain, it pushes it down the road to when it's sold by the beneficiary. But not all farm property, however, is allowed this rollover. Machines, for example, are not covered, but then the question becomes, do you really have an increase in value of farm equipment such as tractors, and then that would be an issue. So it would cover real property, interest in real property, shares of a farm corporation, and interest in a farm partnership, but also cover such things as quotas, etc. So again, if you have clients that are farmers, you have to sit down with them and go over what happens to this property upon their passing and plan accordingly. I just want to quickly go over what the principal residence rules are in the U.S. The reason being, this is sort of a comparison as to what Canada may consider doing down the road. In the U.S., the sale of your principal residence is not automatically tax-free. There is a limit to the amount of gain that can be excluded, and there is a holding period. So in Canada, as long as you've used the property as your principal residence and you have multiple properties, and you meet that half-hectare rule, 100% of the capital gain can be excluded from income. In the U.S., that's not the case. The amount of excluded gain is $250,000 per taxpayer, or if you're doing a married filing joint basis, that's $500,000 of gain that can be excluded. But there is a holding period. The property must have been used as your principal residence for at least 2 of the 5 years ending on the date of sale. And that determination of whether it's your principal residence is factual. If you have multiple properties, you can't just choose whichever property. You have to look at which property was actually your principal residence in order to claim that principal residence exemption. And in the U.S., we also have the ability to deduct what they call home acquisition indebtedness, your mortgage interest. And currently, under current law, that's $750,000 of principal. The interest on that's used to acquire the principal residence can be deducted as an itemized deduction. I actually get this question coming up quite often. It would apply for those high net worth individuals that have US-based vacation properties. So when they go to sell that property, obviously because they're Canadian residents, they're taxable on their worldwide income, and because the sale of US real estate is considered effectively connected income, they'd be subject to US tax as well. So can they claim it as a principal residence in Canada? Absolutely. They're taxable on their worldwide income, and they get to choose which property they can so designate. But the question becomes, should they? Well, in most cases, I say no. The issue you have, not only do you have an actual capital gain in US dollars, but you can have a significant foreign exchange difference. And you could be running into double tax issues. One is the chances are you cannot claim the principal residence exemption in the U.S. because you haven't met their tests. You're not a factual U.S. resident, so there's no way you could have met the 2 out of the 5 years test, which means that the sale for U.S. purposes will be subject to tax. So if you claim the principal resident exception in Canada such that there's no tax, you don't have any basis to which to claim a foreign tax credit against. So you run into some double tax issues. So let's just quickly look at our principal residence again. The question then, is it time for some changes? Is the government going to look at ways of increasing tax revenue to help fund the huge deficits they're currently running? So, as we've seen in the U.S., it's a $250,000 or $500,000 married filing joint exemption on the amount of, or the limit on the amount of capital gains that can be excluded from income. So could Canada impose such a dollar limit, whether it's $500,000 or $1 million? Can Canada impose a holding period? Again, in the U.S., it has to be your principal residence for at least 2 of the 5 years ending on the date of sale. In Canada, we have no such limit, but maybe should they introduce something like that? And that would certainly have a huge impact on the issue of flip properties, because they would always be ordinary income at that point because they don't, by and large, meet the holding period. Let's talk about increasing the capital gains inclusion rate, which is currently at 50%. Does that go up to 75%? It has in the past. Will it, again, be so in the future? There's been talk of introducing a wealth tax, and a number of the European countries have had such a tax as well, and many of them have withdrawn it as well because it's so hard to administer. But do we introduce a wealth tax just on real property in Canada. It's a possibility. One thing we have to consider, though, is even though we can claim the principal residence exemption in Canada, having a principal residence is not truly tax-free. When you buy the property, you pay land transfer taxes on the purchase, and if you live in Toronto, for example, you pay it twice. You pay the Ontario land transfer tax and you pay the Toronto land transfer taxes. And you also pay property taxes while you own the property. And for Toronto 2020, for example, we see that there's an increase of 4.24% of the your budget, your property tax is based on their budget. So you know, the average home in Toronto is paying property taxes of $3,141. And again, we've also talked on this GST, HST, or renovations or capital improvements. So if you fix that kitchen, etc., you're going to pay HST or GST on the supplies to increase that value. And again, we've talked earlier this GST, HST on new bills, and that's subject to some rebate as well. So what advice would you give to your clients with respect to their real property? Questions I think you need to sit down and ask for them. Before they buy any property, who should be the owners? Is it one person who's contributing all the funds? Can the ownership be split so that when it's sold, they're taxed at lower rates? How do you hold the title? Is it joint with right of survivorship? Joint with tenants in common? Do you buy it in a company instead if it's going to be business use? Things to consider. And before you sell the properties, given that there's speculation that the capital gains rates may go up, do you want to crystallize any gains now while it's includable at 50%? What's the timeline? How long your client's going to hold the property before they're thinking about selling it? Is there ability to income split before then? And have we confirmed whether the property now will qualify for the capital gains treatment? Again, the whole issue of capital gains versus inventory. Is it a principal residence? Can you claim the full amount as a principal resident exemption? What are your risks of not doing so? Things you have to sit down with your clients and discuss right now. Given that many people hold real estate for a significantly long time, the question then becomes how much of that capital gain is due to an increase in value and how much of that capital gain is due to an increase in inflation. And should we index our capital gains accordingly to take the impact of inflation out of that? You know, the U.S. has debated it. So President George Bush looked at introducing it in 1992, and Donald Trump thought about the idea in 2008. Neither of them implemented it. But, however, the UK for a number of years had an inflation adjustment, even though it's currently frozen. So in the next slide, we'll take a quick look at that. In this example, we have an individual who sold a capital asset in October 2017 for £240,000. He had purchased it in April 2014 for £140,000. The HMRC, Her Majesty's Revenue Customs, have an index for each month where they put the factor in. And based on April 2014, the factor was 0.077, which meant the index allowance on that 140,000 was 10,780 pounds. So the chargeable gain or the taxable gain is 49,220 pounds because they've adjusted it for this indexation allowance. So should we be doing that here? So what advice will you give your clients? What questions do you need to ask? For dispositions during their lifetime, review the intent at the time of purchase. Why did they buy the land? Is there any documentation to support their intent at that time? Are there any contracts, any planning memos, any documentation whatsoever? How often has your client disposed of real property? Is the issue of flipping really relevant for your client, or have they held this property long term? Do they have multiple residential properties? Again, they can only designate one property per year per family as their principal residence. What do you do if you have multiple properties? If you have deemed dispositions, would the gain be subject to current taxation? Is there any way to defer the gain, taking the capital gains reserve? If so, should you? Do you have any capital losses that that you may claim instead? Given the potential capital gains increase in rates, can you crystallize the gain now? Again, things you need to sit down with your clients and ask these questions. Over the next few slides, we're just quickly going to look at some U.S. real estate issues for Canadian owners, and that's because I've seen these come up quite often. The 1031 exchange. This is usually advised by resident U.S. advisors, not by Canadians, and we'll see what the problem is. FIRPTA withholding, Canada has something similar, and that's just the withholding requirements for foreigners who sell U.S. real property, U.S. estate tax issues, and on the Canadian side, you have the Form T1135 if the property is held for business or rental use. Why is this relevant for our high net worth clients? It's been my experience that a number of our high net worth clients do have significant vacation properties in the U.S. and elsewhere. So understanding the U.S. rules is pretty much a requirement to service them properly. Some may look at owning these properties through corporations. I think that's problematic, and that's because they may have those funds in their Canadian holding or operating company, all right, and obviously there's Canadian tax costs to extract those funds from the Canadian corporation. And again, for U.S. purposes, the sale of a U.S. real property is considered effectively connected income, which means they have to file at least a U.S. federal return, possibly a state return, depending on where the property is located. They need to obtain a U.S. taxpayer identification number. You can't file a U.S. return without a tax ID number, and they don't qualify for a U.S. Social Security number, so they have to apply for this IRS ITIN, which can be an issue at times to get. You need a copy of your certified passport, and when they sell the property, they're going to be subject to U.S. withholding, the FIRPTA, unless they apply for a waiver before the deal closes. The question becomes, if your client comes to you and expresses an interest in buying a U.S. real property, how do you advise them? And I think the first question is purchasing the best choice? I know when the market was down back in the early 2000s, there was a lot of people looking at buying U.S. properties, and I asked the question, how often you're actually going to use this. If you're only using the property 2 to 4 weeks a year, what's it going to do to the other 52 or 48 weeks? Who's going to look after it? Who's going to pay for it? So maybe they don't actually need to be buying the property. Maybe they could be going on Airbnb or VRBO and looking at renting a property for a month, or they can looking at buying a timeshare instead. So again, the question then becomes, should they be buying it in the first place? If they do buy it, who's going to be using the property? Just themselves? Their family members? Do they plan on renting it out at all, such that it's an income-producing properties? Where's the funds going to come from? Are these personal funds they're going to buy the property, or the funds invested in a Canadian corporation such that they have extract them? On death, what do they want to happen to the property? A lot of times, if we're dealing with older couples who are wealthy, there's maybe a second marriage involved with children from the first. So does the spouse get a life interest while she's alive, and the property then reverts to the children? All that has to be looked up up front. And because this U.S. site is asset, it's going to be subject to U.S. estate tax. But the question then becomes, is the U.S. estate tax really an issue? Such that if you do pay estate tax, can it be claimed as a foreign tax credit against the Canadian deemed disposition and death tax? So you need to look at what the global tax exposure is, not just a U.S. estate tax exposure. And I've seen other advisors get so wrapped up in the U.S. estate tax, and I look at it and say, well, it doesn't matter if they pay U.S. estate tax, because they're going to be able to claim it as a foreign tax credit on their Canadian return, because there's been a significant increase in wealth, such as a large capital gain on the Canadian return, and that issue is just missed completely. Again, I've seen this as an issue where a Canadian selling U.S. property is using a U.S. advisor who's never heard of Canada, and it's not that they're wanting to sell and leave the U.S., they want to sell and buy another property. So under the U.S., they have this exchange under Code Section 1031, which allows them to defer the property. It's similar to the Canadian replacement property rules, but the issue is here that it's usually, if it's a rental property, for example, you can do the deferral in the U.S., but it won't qualify in Canada for the exchange rule. So you have a taxable disposition in the U.S. and a deferral in Canada. So you have a timing mismatch in terms of when the foreign tax credits can be claimed and when the gains are recognized. So by and large, even though technically a Canadian can use this, I have never seen a situation where it actually makes sense from a Canadian perspective, and I have advised my clients accordingly not to do it. And again, anytime a non-resident of the U.S., whether it's a person, a corporation, etc., sells a piece of U.S. property, there is a withholding obligation on part of the buyer or the buyer's agent. The IRS is concerned that once the funds leave the country, they have no way of collecting the tax, if any tax is owing. So there are FIRPTA withholding issues that have to be addressed at the time of sale. It could be as high as 15% of the gross selling price. It could be lower, depending on who's buying the property and what the value of the property is. However, you can apply for a waiver for for reduced withholding to equal to the amount of the federal tax, but this has to be applied for before closing. If you're dealing with a U.S. title agent, many times they do not want to deal with this, and they will ignore the fact that you could apply for a waiver. You know, if you're paying $150 or $200 for closing, you get what you pay for. So if you're selling a piece of a fairly high net worth property, there's significant withholding requirements at this time. And again, this is not a final tax. You still have to file a return. You get credit for the tax withhold, so you could get some money back on the filing of the return. But again, if you're dealing with a high valued property, you want to use an attorney. And you want to use an attorney that A, knows the international tax law of the Internal Revenue Code, and I'm not being facetious here, has heard of Canada, and they actually know what they're doing with respect to foreign sellers. And as clients get older, there could become some health issues with respect to them, and how does that impact their decision to keep or sell property? Is personal health restricting your client's ability to use the property? Do they need to move into assisted living facilities, for example? Are they able to travel? If they don't use the property as much as they want to, what are the costs of maintaining ownership? Does it make sense for them to continue to own the property? Is the market in a good phase? Is it in an up phase right now such they can maximize the gain on sale? If it's foreign property, even if they're healthy, can they access it right now? You know, you could fly to the U.S., but you can't drive, and this is really a big issue for non-Canadian snowbirds, is they can't drive to the United States. And they have concerns about whether they're able to use their U.S. properties or not. I know of one person who lives in a fifth wheel who stays in Canada for the summer, moves to Florida for the winter. He can't go to the Florida right now. He can't take his fifth wheel across the border. So he's had to arrange to rent short-term accommodation for the winter in Canada. It's the first time he's going to spend winter in Canada for years, but it's a real issue. So, and also when you're looking at selling the property, to whom and where does the client want the property to go if it's not being sold? It's going to be dealt with as part of their will, as part of their estate plan instead. Quickly, I just want to touch on the U.S. estate tax. This is extremely political. We have provisions under the Canada-U.S. tax treaty, so unless your net worth is currently over U.S. $11,580,000, you will not be subject to U.S. estate tax, even though you will have a filing obligation. Again, this is very political. If Democrat nominee Joe Biden wins the presidential election, we'll see if the exemption limits get reduced. Some of the Democrats have talked about reducing it back to $3.5 million, which is what the limit was under President Obama. For U.S. individuals living in Canada, the outcome of the U.S. presidential election could actually have some significant impacts, especially if they own a CCPC. Why? Because the two rules. One is what the U.S. corporate tax rate is, and what they call GILTI, which is a global intangible low taxed income, and how that impacts foreign corporations. If Biden wins, he's talked about raising the U.S. corporate tax rate from 21% to 28%, and raising the GILTI rate from 10.5% to 21%. And what it becomes is, because that 21% is higher than the Canadian corresponding corporate rate for Ontario, for example, on non-CCCP business income that's 26.5%, that could really mean that there's a double impact for U.S. citizens owning Canadian companies. For Canadians, what is the impact of the U.S. Elections? Again, it's the estate tax issue. If the estate tax rates either go up or if the exemption amount decreases, that could mean that Canadians who own U.S. real property could be subject to more U.S. estate tax. The income tax may also be an issue, again, with the foreign exchange gains, and will Canada grant a full foreign tax credit? And who's going to inherit the property? We saw earlier that might be the millennials who are inheriting it from the boomers and the Generation X's, but the question then becomes, do they actually want to inherit these properties instead? If not, what's going to happen to them? Is that part of your planning? Again, the issue for high net worth Canadians that own U.S. property is when they buy the property, how does your client structure the acquisition of the property? How do they take title? Who will actually fund the purchase? Again, is it personal funds or corporate funds? Should your client buy insurance to cover the estate taxes instead of setting up a trust or setting up a corporation? Things that you need to think about. I'm going to quickly skip over the next few slides, but I said these are the ones that are left in, so you get some information about who has the wealth, where is the wealth, what age brackets have the wealth, etc. So they're in there for your reading opportunity. From an advisory standpoint, the question then becomes, what's the business opportunity? Are you working with the right client? Is the client open to your suggestions? Do your values align? Are they interested in price or service? If they're just looking after the price, they're probably not going to be a good client for you. Do they appreciate your value add? Can you research the client? There's a lot of information on the website, and you can go online and find out about them. Are they willing to form a long-term partnership with you? What's their time horizon? Are you looking at getting their kids as part of your client base as well? So when the transition happens, you can advise both the elder generation and the receiving generation. Can you assist with the wealth transfer? And don't be afraid to fire bad clients. They take up far too much of your time, don't pay enough fees, and simply are not worth it. We can see this slide that there are risks to wealth, and the question becomes, how do you manage those risks? What are the types of risk, and how do you deal with that risk? And I think so now you have to analyze and track the wealth. And we see that markets in general are still robust, even though they had a big dip in March and April. The markets seem to recover from them. And if you're in the tech industry, those shares are doing very well. So again, when you're dealing with your clients and diversification of assets, you might want to look at what type of assets they own and what their beta is with respect to market as a whole. As the market goes up, as the stock goes down, you probably want to diversify accordingly to reduce the systematic risk in the market. We've talked about the real estate. It still seems to be going up and down. There is a high level of volatility in the market, and you should avoid panic selling when the market, you can't time the market. You just will always lose if you try and do that. We know that due to the current pandemic, the government's running huge deficits, so there's going to be some looming tax issues. How are they going to pay for these deficits down the road? So the next few slides talk about the ballooning deficit in the sense, how will the deficit be paid? Will it actually be paid? Some of the ideas in terms of potential high net worth tax, restricting the capital gains limitation, increasing the capital gains inclusion rate, some examples of what that may look like. Do you think it's fair? Should we be indexing capital gains? Some examples there. Again, should there something be considered about what to do if your clients have multiple property? Is it time that we look at interest deductibility in Canada? I can't see that happening. Some intergenerational planning. Where's the life cycle for your clients now? How much and who to the assets are going to be transferred? Can this be done in a tax efficient manner? All these things need to be considered and are in the next few slides. So as we're coming up to my 40-minute time slot, let's do some conclusions then. Proactive planning. If you want to become your client's go-to advisor, you need to be proactive. Look at their asset holdings, look at their debt holdings. What's their net worth? How can you increase that net worth? Looking to acquire assets. When's a good time to do it? What's their need for cash? What's their time horizon? Is the market up or down? When's a good time to sell? When's a good time to buy? You need to sit down with your clients and go over every possible opportunity and solution out there in order to maximize the advice that you're giving them. So in my conclusion, my 3 bright insights from me to you. Hopefully you'll consider these. You want to become your client's trusted advisor, and that means getting to know all your clients' details, intimate details. You should know everything about them. Every time they have a question, they should be willing to get you involved. You can't provide good and effective advice if you don't have all the details. You're working in a vacuum. Work with other advisors. Become the quarterback. You may have an area of expertise, but you don't know everything. bring in people as required to assist you in serving your client. Be proactive, not reactive. Have at least an annual meeting with your client. Go over things. How's the family? How's the state of the union? Have there been any changes in their thought process? Be prodding, get them to think, get their clients to think. You'll provide an overall better service and better plan for them. And concentrate on service, not price. If they feel that there's a value add that you're providing, they will be willing to pay you for your service. Never go in as a low-cost service provider, because then that's how you're going to be looked at, providing a cheap service, and they're not going to fully appreciate you. That takes up my 40 minutes. I hope you enjoyed it. Thank you very much for listening.